Why are central bank economic forecasts often met with skepticism? Imagine trying to predict the weather months in advance. Sometimes the forecast hits the mark, but other times it's way off. Central bank forecasts work the same way. They aim to predict inflation, growth, and unemployment, but often miss the mark. Why is that? Well, a few key reasons stand out. First, the economy is full of surprises. Unexpected events like geopolitical conflicts, pandemics, or sudden jumps in commodity prices can change everything overnight. These shocks are hard to predict and can throw off even the most carefully made forecasts. Even small changes, like supply chain issues or shifts in wages, can cause big differences between what was predicted and what actually happens. Second, central banks and forecasters tend to be overconfident. They often believe their models are more accurate than they really are. Studies show that forecasters usually give high confidence levels, but they are correct only part of the time. This overconfidence can make their predictions seem more reliable than they truly are, which can lead to skepticism. Third, there is often disagreement among experts about how the economy works. Different models and assumptions about inflation expectations, wage price feedback, and supply and demand can lead to varying forecasts. This disagreement shows how uncertain the true drivers of inflation are and how difficult it is to predict their future movements. Fourth, inflation itself is complex. It is influenced not only by demand, which monetary policy can influence, but also by supply shocks like shortages of raw materials or geopolitical tensions. Recent experiences have shown that inflation does not always respond predictably to interest rate changes or monetary tightening. This makes it harder for central banks to control inflation through their usual tools. Fifth, the trust in a central bank's ability to keep inflation stable affects how much people believe their forecasts. If a central bank makes mistakes or faces a crisis, its credibility can weaken. When trust drops, people tend to be more skeptical of the forecasts and inflation expectations. All these factors mean that central bank forecasts should be seen as educated guesses, not exact predictions. Policymakers use them as guides, but they need to stay flexible and ready to change course as new information comes in. Skepticism is natural because many variables outside the central bank's control influence inflation, and models can't capture every detail of the economy. This skepticism encourages businesses, investors, and governments to prepare for different possible outcomes. It also highlights how important clear communication from central banks is about the limits of their forecasts. Improving forecasting methods is an ongoing challenge, especially as the economy becomes more complex and unpredictable. So, while central bank forecasts are helpful, it's wise to treat them as part of a bigger picture, not the final word.